With US inflation data coming in lower and lower, it's looking more and more likely that interest rate will start coming down in the next few months. In this video, we'll go through the recent news for DBS, OCBC and UOB and what to expect from their upcoming earnings. I'll also share my opinion on the potential impacts of interest rate cuts on the three banks and the catalysts that might benefit the banks to continue to perform well. DBS Bank has been one of the standout dividend investment choice in Singapore Stock Exchange for a very long time. In recent years, due to high interest rate, they have been able to benefit together with the digitalization, which resulted in their dividends increasing greatly for the past 2 years with special dividends. Based on the 10-year compounded annual growth rate for their dividends, they have the highest growth rate at 14.8%. This again shows the consistency in the dividend growth by the DBS Bank management. In recent news, the DBS CEO has mentioned about the benefits of Trump potentially winning the presidential election, with the economy most probably improving for both US and China. This will definitely benefit in all the banks including DBS. I'm cautiously optimistic with this, as I feel that it's hard to predict what will happen with different presidential candidates. Another bigger news is that DBS was recently selected by blockchain and tokenization infrastructure platform Paxos as its primary banking partner for cash management and custody of stablecoin reserves. Paxos provides reliable coins such as Bitcoin and Ethereum for retail investors in companies such as PayPal or interactive brokers to purchase in. This is big because this essentially provides DBS with more opportunities to have more reserve and potentially more income from transaction fees. On top of that, DBS crypto arm have reported triple in trading volume. Number of active clients have risen by 36%, while digital assets surged over 80%. With the recent rise back in popularity for cryptocurrency and investors trying to find a reliable place to store their crypto, DBS Bank will definitely benefit greatly from this opportunity. If we see the Q1 earnings, income from commercial books and market trading was already at record high. With the crypto inclusion news, I will not be surprised they might be able to hit another new high in profits. Net interest income might not increase, but the fees and treasury customer sales and other incomes might come in surprisingly higher. Moreover, like I mentioned in my previous analysis video, they have a very strong CET1 ratio of 16.2% even after giving out the dividends. This shows how much capital DBS Bank have in potentially investing to expand the business or give higher returns to shareholders. Currently, I'm still optimistic that DBS Bank will continue to do well, deliver strong earnings and shareholder return this year. Moreover, with the crypto news, this will definitely be a potential driving force for DBS to continue doing well, with their non-interest income expected to continue to go up. Unless I see any cracks, at this moment, I feel that it's still a very solid investment. If you like the video so far, please support the channel by hitting the like, subscribe, and leave a comment on what you feel about DBS as well. Thank you, and let's go on to the next bank. The next bank will be OCBC. OCBC also has good news recently with the acquiring of more assets in the Great Eastern Stake Holdings. This is not the first attempt that OCBC had tried to take over GE. 2 decades ago, OCBC increased its stake from 48.8% to 81.1% on its first attempt. Second attempt to 86.9%. Recently, for their new attempt, it finally went over 90% stake at 93.32% stake, with OCBC offering 36.9% premium to the GE share price of $18.70, but it's actually a 30% discounted per GE's net asset value. Now, what makes this such a unique breakthrough is that OCBC has essentially privatized GE. Why? Because with 90% stake, GE shares in the Singapore Stock Exchange will be delisted, which means the remaining shareholders holding the 7% will not be able to trade in the open market. This essentially removes the liquidity and can only sell them to OCBC. This will force the remaining shareholders to either sell their shares, else risk it being illiquid. This is undesirable as you do not want to hold shares that are actually hard to sell. As investors of GE who do not want to sell, this is definitely terrible. But if you're OCBC shareholder, you should be happy as OCBC is buying a good business at a discounted price. However, even with this purchase, their CET1 ratio, which determines how much cash the bank has, will still be at a very high value. This gives more investment opportunities to continue growing OCBC Bank and provide good returns to shareholders. Overall, OCBC has been very prudent in their reserves, and I hope that they will be able to continue bringing good profits and raising dividends in the near future. Next, for UOB, it has been quite a quiet period as compared to DBS and OCBC for this quarter. But their main highlight would be their cutting of interest for the UOB 1 account. The drop is huge, with interest earned for balances of 100k dropping from the old interest rate range of 3.85% to 7.8% to the new interest rate range of 3% to 4.5% per annum. Even with this huge drop, it is still giving a higher interest rate as compared to DBS multiplier at 4.1%. Honestly, this is good for UOB as this will reduce the expenses and improve the net interest margin. Out of the three banks, UOB net interest margin is lower at 2.02%. OCBC is at 2.27% while DBS is at 2.77%. Overall, I will be focusing on their other fee income and non-interest income as I hope that the integration of business purchased from Citibank will be able to benefit UOB greatly. At their current share price, the potential dividend yield seems to be lower as compared to the other two banks. Hopefully, we will be able to see decent growth ahead for UOB. Overall, even with the risk of interest rate coming down, I feel that banks will continue to do well because it works both ways. Banks' net interest income might drop, but the lower interest rates will bring better economy and encourage business to take on more loans. If you see historically, even in periods of low interest rates, the banks are still able to continue doing well and increasing their dividends. Now, why is this so? It's largely because they are giving only 50% of their income as dividends. This means that they have the other 50% to either reinvest in themselves or give returns to shareholders. I will not be worried for the interest rate cuts, but more of focusing on them as long-term dividend investing. Another potential catalyst that I want to mention is the potential closure of CPF SA accounts in 2025 for those who are aged 55 and above. In more of my previous video, I've mentioned the potential benefits they have to Singapore banks. I feel that most people will definitely want to take their cash out, else your SA account savings will no longer be flexible for you. This is because any remaining SA amounts will have to be transferred to RA first to fill up to the full retirement sum before the remaining is transferred to your OA account. As of the December 2023 report, there are 328 billion in balance for those people who are aged 50 to 80 and above. If we assume 40% of these balances are being taken out, this means there's a potential of 131 billion of additional customer deposits being taken and put in financial institutions. Banks will definitely benefit from most of them as people putting these savings will want a safe location of their assets. Do let me know if you would like me to work on CPF videos as well. By this moment, I would expect a lot of people to take out and transfer to banks for them to hold in year 2025. This will definitely benefit banks with more deposits and thus more capitals for the banks to operate. I hope you find this video informative. If you like it, please support the channel by hitting the like, subscribe, and comment on what your thoughts on the interest rates on banks. Thank you, and I'll see you in the next video.